Good afternoon, and thank you for joining us today. I'm Matt Rosen from the Office of State Treasurer Colleen Davis. Unfortunately, Treasurer Davis could not join us today, but I will give some quick remarks on behalf of Treasurer Davis and the Office of the State Treasurer. If you're watching this live stream, I assume it's because you have student loans, which probably means you dedicated a lot of time, effort, and money to getting a good education for yourself and earning a degree. And with the education you received, you probably had a lot of options for where you could work. But in the end, you made a decision to work in public service for the state of Delaware. And we're really glad that you made that decision. We're appreciative that you gained all of that knowledge and expertise through your education and that you're using it to make state government work better and deliver services to the people of Delaware. You should be rewarded for doing that. You certainly should not have to suffer a lot and endure hardship for getting that education and using it for good. And yet that's what a lot of state employees experience because of their student loans. And with student loan payments restarting after a long pause, we know a lot of you are worried about how you're going to afford it. And that is not great. You deserve better than that. You have better things to do with your paycheck than dumping an enormous amount of it into your student loan payment every month. We would love to see you take that money, save it for retirement, your kids' college education, buying a home, or just everyday necessities. So we had a live stream with Heather Jarvis a couple weeks ago, and if you haven't watched the last live stream yet, the link to the recording is in this video's description down below. And that live stream was about student loan forgiveness because we don't want you to be paying off your student loans for the rest of your life. And we hope that that presentation will help a lot of you get closer to erasing your student loans once and for all. But of course, many of you will still need to keep paying your student loans for a while longer before you can get forgiveness. And we don't want that to be a huge stressful burden for you. Thankfully, though, there are ways to make your repayment easier, more affordable, and more manageable. And thankfully, Heather Jarvis is here to explain all that to you. And we really hope that you'll learn things today that will relieve your financial pain and make you feel much better about your student loans. Quickly, before I introduce Heather and get started with all that, let me say thank you to Ashley Block from the Department of Human Resources for partnering with us on this initiative and being here with us today. Let me turn it over to Ashley for just a minute so she can share a few words with us.
Good afternoon, everyone. I'm Ashley Block from the Department of Human Resources. Happy to be here to share a few remarks on behalf of my department and Secretary Claire DeMattias, who unfortunately couldn't join us. But I would echo everything that Matt said. We're happy to partner with the Office of the Treasurer to present this webinar. I know I'm a student loan holder, and with the long pause that we've had, we wanted to make this available to our state employees, and that you would know that it's a valuable resource to help you navigate what can be confusing and challenging. So we hope that you really benefit from today's webinar and that you feel more informed and that you take advantage of this because, as public servants, this is a huge benefit for you if you're a student loan holder. So I'm going to turn it back over to Matt. And Matt, I believe this is also going to be available on the DLC, correct? The recording.
Yeah, I think we'll be, the plan is to post it on the Delaware Learning Center.
Yeah. So I just wanted to share that. So thank you, and I hope you enjoyed.
Thanks so much, Ashley. Really appreciate it. Before we get started, some quick information. I've said this before, but if you have not yet done so, please sign up at de.gov/student loans. That way we can send you the slides from this presentation. And in the future, we can also send you updates, new information about student loans, helpful resources, and info about future events like this one. We already have some very helpful resources for you at de.gov/student loans. If you scroll all the way down, you'll see a list of links to information and resources about the topics we're discussing today and some other topics. Also, you can ask questions during this presentation. Just type your question into the live chat on the right side of the screen. Or if you're on mobile, the live chat may be below the video. That being said, we only have 1 hour, and Heather can't answer every single question that every single state employee has. So if you have further questions, please contact me or contact the U.S. Department of Education, and you can find information for both below in the video description. Also, if you would like Heather or me to present to your state agency so that we can provide more information and help answer more questions, then please contact me and we'll see if we can make that happen. Without further ado, let me introduce our presenter for today. Heather Jarvis is widely known for her depth of knowledge and accessible teaching style. She has provided student loan education and consultation for universities, associations, and professional advisors since 2005. Heather graduated cum laude from Duke University School of Law in 1998 and dedicates her professional efforts to advocating on behalf of high-debt student loan borrowers. Heather contributes to student debt relief policy for the House Education Committee and others in Congress, and recently completed service on the American Bar Association Task Force on Financing Legal Education. So, thank you for being here today. Thank you so much. And by all means, please proceed with your presentation.
Thank you so much, Matt, and thanks to the state of Delaware and to Treasurer Davis for their leadership and for the Department of Human Resources. Thanks so much for your commitment to helping the citizens of Delaware and the state employees with their student loans. So let me just start by saying that everything is going to be okay. These loans are flexible. Federal student loans are very flexible. They have a lot of provisions that make it manageable for us. They can sometimes be somewhat confusing. So I will take you through the information I think is that you need. And as Matt said, happy to answer questions as well. And if I'm not mistaken, the visual aids are shown now, and we will be moving through them. So today we're going to talk about the differences in student loan types, what kind of terms they have. I want to talk to you about something called Fresh Start for folks who might be dealing with default. And also we'll talk about repayment plans, including the differences between repayment terms and income-driven repayment options. So let's do that and move now to the next slide. So federal student loans are the most flexible student loans, but they also tend to be rather tricky. Start by getting a very clear inventory of your loans at the United States Department of Education website. Now, you may also have access to your loan servicing company's web portal. You've been assigned to a servicer for your student loans. That's a company, for example, such as Mohila or Nelnet or AidVantage or Ed Financial, and you will interact with the loan servicing company, who is a contractor for the federal government. But you should also visit studentaid.gov, because that's the central resource of information about your federal student loans. And so get a clear inventory there by looking at your aid data when you're logged into studentaid.gov. Now, you may also have private student loans. There is no real central repository of information about private loans, but what you can do is visit annualcreditreport.com, where you can get a free copy of your credit report. And if you look through that, all of the student loans, or sometimes they're referred to as education loans on the credit report, all the loans you see there that are not also on the federal student loan site will be your private student loans. So private student loans include everything that's not federal. So these could be loans you got from your university directly, or from a private bank or lender, or some nonprofit organization that may have a loan program. Okay, so a lot of what we talk about today will relate mainly to federal student loans, because private student loans are more like other kinds of consumer credit than they are like federal student loans. So the main way to handle your private loans is to understand the terms of the loan itself by reading through the contract, known as the promissory note, and you can request that from the lender. You can figure out who the lender is on your credit report and then ask for more information. I will talk now mostly about federal student loans, but happy to get questions about private loans as well. And I will throw in a few caveats with regard to private loans as we go through today. So next slide, please. Whenever we borrow money, including student loans, we pay something for that privileged to have used funds that we hadn't already earned. And the main cost of borrowing is interest. And one thing that is not necessarily intuitive is the fact that interest accrues over time. So the way interest works is that you borrow money, and that's called the principal balance. And you borrow that principal at a particular interest rate. And for federal loans, the interest rates are set by Congress. So you have no control over the interest rates you have. You will have a lot of different interest rates on your federal student loans. And so you borrow principal and you pay interest at a particular interest rate. And that interest accrues on the principal balance over time. So, for example, looking at a couple of, sort of simple examples, we see that if you borrowed $10,000 at a 6% interest rate, that means that 6% of $10,000 or $600 is the amount of interest that accrues over the course of 1 year. So if you owe $10,000 at 6% for 1 year, the amount of interest you're going to pay is $600. So that amounts to $50 a month, is essentially the cost of owing $10,000 at 6% is going to be $50 a month. But then, of course, if you owe much more, as some of us do, then you could pay much more. So the cost of borrowing is going to depend on 3 things. It's going to depend on how much you borrow, the principal, and it's going to depend on your interest rate, and it's also going to depend on the passage of time. So traditional debt management tells us that the best way to save money on debt is to pay more aggressively, to pay more quickly, because the more quickly you repay the debt, the less time over which interest can accrue. The only real other ways to reduce the amount of interest that accrues on federal student loans would be if you could lower the interest rate, which is not available within the federal student loan system, or if you could reduce the principal, which means, borrow only what you need. But once you've borrowed what you needed, you really can't reduce the principal without paying it down. But this traditional debt management strategy of paying quickly so as to reduce the amount of interest that accrues, it doesn't make sense for everyone if you might have some potential for forgiveness of your student loans. And certainly also paying aggressively requires adequate cash flow and depends on all the other considerations and obligations that you have to spend your money on. So that's sort of the starting point for debt, is to understand the way interest accrues. And next slide, please. If you are someone, and there are many people that have experienced this, if you are someone who has default on your federal student loans, that means that there was a time when you did not make payments for 9 months, and then your loan was put in a status, as we say, of default. Now, default can be very difficult to manage because your options are reduced. And so I want to be sure that people are aware of something called Fresh Start. Fresh Start is an initiative of President Biden and the current administration at the Department of Education in order to help people have a path out of default. And since the COVID-19 pandemic in March of 2020, we had suspended interest accrual and payments on federal student loans. But as of September 31st or October 1st, I guess September 30th, right? There's not 31 days in September. Then at that point, this COVID suspension or COVID payment pause has come to an end. And so what that means is that people who are in default had been granted some relief during the COVID pandemic, as had others in the student loan system, but that relief has come to a close, and it's important now, if you haven't already, to take advantage of Fresh Start if your loans are in default. So the way to do that is to, contact the Department of Education in one of these three ways. You can obviously do it online, by phone, or by mail. It's smart to grab your income information before you go to the website or make the phone call, because you will also be given an opportunity to enroll in a repayment plan known as an income-driven repayment plan, and we'll be discussing those here at some length. So grab your income information. Typically, they like to use adjusted gross income from your most recent tax return. You find that on line 11 of the 1040. So next slide, please. The Fresh Start has lots of benefits. It will prevent what we call forced collections, which is like the seizure of tax refunds or the like, and it will restore eligibility for other borrowing from the government, and will also have benefits, positive benefits for your credit. So Fresh Start is a limited time opportunity. My understanding is that it will continue through 2024, but it is best to take advantage of this opportunity now so that you can begin progressing towards some further relief, potentially forgiveness for an existing student loan balance. After the Fresh Start period, there will be other ways to cure default that are less advantageous to you as a student loan borrower. So happy to take other questions about that when we turn to the Q&A period. And now I'd like to turn to the next slide and repayment plans. So one of the things that's good about federal student loans, is that we have a lot of choices when it comes to repayment plans. So it's good to have options, but it's also confusing, especially because right now there are so many options, and sometimes when you look at the forms, it seems like they're being presented as if they are all equal, and it can be hard to know what might be best for you. I want to begin by encouraging you to choose thoughtfully which repayment plan will be best. And there are two essential categories of repayment plans. There's something called a term repayment plan, which just means that you make payments over a specific period of time, a specific term. And for federal student loans, the standard term is usually 10 years, but there's some more detail on that that we'll talk about in a moment. And that's the kind of thing you're used to, right? With like your mortgage, for example, if you have one, or an auto loan, you would make fixed equal payments every month over a specific period of time. And the way those payments are arrived at is by evaluating your indebtedness, your principal balance, as well as your interest rate and the period of time over which you will be paying. So as we discussed a minute ago, if you know the principal balance and you know the interest rate and you know the length of time over which you will owe the money, you can evaluate how much interest will accrue over that period. And so that's what happens in a traditional repayment plan. And we'll look at that in a little more detail. Then we'll turn to talking about the income-driven repayment plans, which are completely different. So next slide, please. So you hear a lot in the federal system about standard repayment, but there's more than one standard. So it's really, the terminology can be somewhat confusing. Usually a standard term means a 10-year period if the loan is not a consolidation loan. So if it's any of these other kinds of federal loans, like unsubsidized, subsidized, or a plus loan. But if it is a consolidation loan, the standard term can be longer than 10 years. In fact, it can be as long as 30 years, depending on your balance. I do want to give you a note of caution. So a warning, essentially, for student loan borrowers, and this is important, that the graduated and extended repayment plans for federal student loans are rarely the right choice in today's environment. So please check your student loan accounts and see which repayment plan you're enrolled in, if any, and give some consideration to the options. But remember that graduated and extended plans do not permit you to progress towards forgiveness. Forgiveness is tied to the selection of an income-driven repayment plan. And sometimes you can also progress towards forgiveness with a standard plan. There's lots more to learn about that in the session we previously did that Matt mentioned. The recording is posted for your review if you choose. But my point today that's important when we're talking about repayment plans is that you should give some careful consideration to which plan you choose. Especially the income-driven plans have many advantages, including the potential for forgiveness. And the graduated and extended plans in particular are really kind of outdated and not very good for most people. So I want you to be aware of that so that you don't inadvertently choose a plan that will fail to help you in the way that an income-driven plan might do. Okay, so next slide, please. If you do have a consolidation loan or choose to consolidate at some point, then your standard term of repayment will depend on your balance. And consolidation is something that a lot of student loan borrowers have heard of. It's one of the terms that we hear. That just means that you get a new federal student loan called a consolidation loan, a direct consolidation loan, and that loan repays one or more of your other previously existing federal student loans. So you can choose which loans to consolidate or not consolidate. And consolidation is only important for some borrowers. If you have older federal loans, so now I'm talking to people who borrowed before the year 2010. If you borrowed before the year 2010, then you should double check whether all your loans are direct loans. You can see that at studentaid.gov, and you should look and see if all the loans you owe a balance on are still or are labeled as direct loans. If you see something else, if there's a loan that doesn't include the word direct, you're the person who should give some careful thought to consolidation, and there is a time limit to get the most benefit of consolidating. We have until the end of this calendar year, December 31st, to consolidate those older loans and into the direct loan program. But now many of you will already have direct loans and direct loans only for federal student loans. And if your loans are all direct loans, there's no requirement that you consolidate. There may not be any benefit to consolidating, and it in fact may foreclose some of the flexibility you could have if you did not consolidate. So give that thoughtful consideration as well. Many people do not need to consolidate, especially if your loans are already direct loans. I do want to differentiate between consolidation and refinancing. Refinancing is the term I like to use for when you approach a private bank or lender to issue a new loan to repay your existing student loans. That is an option. It can be useful for some borrowers. It is occasionally a way to reduce the interest rate on student loans, but be very cautious about refinancing with a private lender because you would waive your federal protections. And federal student loans are unique in that they have flexible repayment provisions, access to forgiveness, and discharge provisions, for example, like death and disability discharge. So refinancing is risky and should not be done without careful consideration of what you would give up. Okay, so yay, next slide, please. Now we will be talking about how a payment is allocated or distributed to your loan balance. So what you see on your screen now is what we call an amortization, and it shows what happens if you take a student loan balance and its interest rate and you distribute that loan repayment over a fixed and equal period. This is your so-called standard repayment. And what I want to point out to you, because it's not necessarily intuitive and I get many questions about it, is that when you make a payment, some of the payment is attributed to the interest that has been accruing on the loan, and some of the payment is then attributed to reduce the principal balance. And we want to reduce our principal balances if we want to see the amount of interest that accrues reduced. And so what is important to see about this example is that in the early months of repayment, there is a larger proportion of the payment that is attributed to interest and a smaller portion of it that is attributed to principal. And that's because when the principal balance is higher, the interest that accrues is more. So, and a standard amortization table like the one you see here shows how the principal balance reduces over time. And as you can see in the early part of repayment, this is showing the first year of repayment, the amount that is reducing the principal is only a portion of the amount that is paid. And it's less at the beginning than it is towards the end of the term. So, all right. So next slide, thank you. And now one of the most important probably concepts in student loans is something called income-driven repayment. And this is a way of paying back money we owe that is unlike anything you see in the private market. It's not going to be like your mortgage or your credit card or your auto loan. Under an income-driven repayment plan, payments are going to be set according to your income and your family size. And so income-driven repayment, or IDR, is an umbrella term that is meant to encompass the various repayment plans that set payments according to income. They all have their own acronym and it's a confusing array of names, but the best plan for many people is called SAVE, or Saving on a Valuable Education. This is the newest plan crafted by President Biden's team to provide relief to student loan borrowers, especially those who have lower incomes. And so the SAVE plan is the newest of the IDR plans, and it will result in the lowest required payments for almost everyone. There are also, though, some trade-offs and some differences between the plans. So we'll look at a few things about that. And I do want to say, before we look at that detail, that forbearance is an option for folks who need to temporarily postpone their obligation to make payments. Forbearance and deferment are terms that you'll hear. They are similar in that they're options for postponing your requirement to pay. And the sort of cautionary note that I want to offer you is that forbearance is rarely the best choice for people who need lower payments because of their income. So forbearance is available, and I don't mean to say that it's never the right choice, but please think first about enrolling in an income-driven plan. So, or if you're already in an income-driven plan and you experience some financial hardship, for example, perhaps you were laid off between jobs, you can have your payment recalculated and reduced under an income-driven plan according to, circumstances, including reductions in your own income. So next slide, thank you. So what the income-driven plans do is they start by protecting a portion of your income so that it isn't used to make student loan payments. So what they do is they evaluate something that is called the income protection threshold, and that just means an amount of your earning that is not subject to student loan repayment. So they start by looking at the federal poverty level, which is published annually, and they look at the federal poverty level that corresponds with your family size. So if you see here, this is the 2023 federal poverty rates. There will be another table published in the spring. Next slide, please. And your family size is important for determining which federal poverty level will be used in the calculation, right? The larger your family, the more income is protected. And the way family is determined is that you get to count yourself, the student loan borrower. If you have children that you support financially more than 50%, you get to count them, whether they live with you or not. You get to count your spouse only if you file a joint federal tax return. You have the option of filing a tax return as married, but filing separately. And if you do that, then you don't get to count your spouse in your family size. But you also don't have to count their income in the income-driven repayment calculation. So that's a trade-off for married borrowers. And a lot of us married folks, we file joint tax returns as a matter of course because you pay less in taxes often by doing so. The tax code is structured to encourage married people to file jointly. For example, you have access to certain credits and deductions that are not available if you're married and filing separately. Married filing separately is subject to a somewhat higher tax rate. So many married couples will pay more in tax if they choose to file separately, but sometimes it can be worth it from a student loan perspective. So my message to you is that when tax filing season comes around again next year, make a conscious choice about whether it makes sense for you to file married jointly or married separately, and consider the student loan consequences when you do so. And that is the wise move. Last thing about family size is that you may also include other members of your household that you support financially. So that could be, for example, an elderly parent or relative that lives with you and that you support. So great. So next slide, please. So I mentioned this income protection threshold, and what this is this is a percentage of the federal poverty level that corresponds with your family size. And so the percentage that is protected is going to insulate some of your income from student loan payments. So the higher the percentage that is protected, the better off you are, and the lower your required payment is. So under the new SAVE plan, as you see on the left side there, 225% of the federal poverty level is protected. Whereas under income-based repayment, it's less, 150%. Under income contingent repayment, it's even less, only 100% of the federal poverty level. Now let me pause and speak to the parent borrowers that may be joining us today. So many people borrow money to help their children, their dependent children, pay for undergraduate education. And there's a federal student loan for that called the Parent Plus Loan. The Parent Plus Loan is for parents of dependent undergraduate students. There's also something called a Grad Plus Loan, which is the one that we get for our own education if we are studying in a graduate or professional field, a post baccalaureate program. Parent Plus loans, not Grad Plus loans, but Parent Plus loans are not eligible for the best income-driven repayment plans. And that's the main reason that I include information about the plan called ICR, or Income Contingent Repayment. because income contingent repayment is the only plan that parent borrowers can access in terms of an income-driven plan. So parent borrowers can choose a standard term of repayment or an extended term. They can consolidate and have access to a longer term of repayment. But when it comes to an income-driven plan, the only one they can access, parent borrowers for Parent Plus loans, is income contingent repayment, or ICR. And even then, the only way to access ICR is if the parent borrower first consolidates. So they would have to take their Parent Plus loan and apply for a direct consolidation loan that repaid the Parent Plus loan, or more than one Parent Plus loan. And it's also possible to include one's own student loans for one's own education in a consolidation loan together with Parent Plus loans. So for example, if I have my own student loans from my undergraduate degree and my law degree, and I have parent loans for my adult children, it is not a good idea to include parent and student loans in the same consolidation. And that's because if you have a consolidation loan that paid a Parent Plus loan, you will not be able to choose any income-driven plan for that consolidation loan except ICR. And ICR can be a path to forgiveness for parent borrowers. It's the only chance to progress towards forgiveness, either public service loan forgiveness or a longer term. The only way parents can access that is via consolidation and ICR. But don't include your own student loans together with the loans you got for your kids, or you'll have fewer options for your own student loans than you had before you combined them with the parent loans. The parent loans essentially infect the whole consolidation loan and make it ineligible for any plan other than ICR, which is far less generous than the other plans. Okay, great. So next slide, please. So then, as you can see, this is my federal poverty level chart that shows 100% of federal poverty, 150%, and 225%, just so you can see how much income is protected under the individual plans. Like if you have 4 people in your family, for example, under the ICR plan, only 100% of federal poverty is protected. So you can only earn $30,000 before the rest of your income is subject to payment to student loans. Whereas under the SAVE plan, a family size of 4, it's protected $67,500. Obviously a significant difference. And next slide, please. So income-driven repayment plans depend on income, right? So it really matters what that means. What is income? When they say income, what does that mean? Is that salary? No, what it is if you give the Department of Education permission to access your tax records directly from the Internal Revenue Service, then they will use the adjusted gross income from your most recent federal tax return. And if you're married and filing jointly, they will use the joint income amount. If you file separately, they will use the separate amount. And if you're single, they will use the AGI from line 11 of your 1040. Alternatively, you may choose not to give permission for them to access your tax record, and you may instead provide alternative documentation. And you're given this option, for example, if your previous year's earning does not reflect your current income. So you'll be asked if your current income has substantially declined or decreased since your last tax filing. And if it has, you can say, hey, my income is less now than it was last year, so don't use my last year's tax return, I should say. And then you'll be able to provide alternative documentation, which is usually going to be something like a pay stub. Next slide, please. And so the the income documentation is very important because it determines how much your payment is going to be. So, all right, so what you see before you here is the amount of income that's not protected under the income protection threshold under these plans is considered so-called discretionary income. And that's the portion that is subject to a percentage going towards your student loans. And the plans have different ways of setting that up. And so what you see before you here is an example of a family that earns $50,000 in adjusted gross income. This is a single person, or perhaps a married borrower filing separately, so their family size is 1. And as you can see, their discretionary income is going to be less under the SAVE plan on the left side and the most under the ICR plan on the right side. And that's because of the way the income is protected or not protected. Next slide, please. And then here's an example of a person who earns twice as much, a person who earns $100,000 in a year, and they will have, as you can see, significantly higher discretionary income, and that's the portion that they'll have to make payments from. So next slide. This is where you see what the actual payments are going to be. So the payments under the SAVE plan and the IBR, or income-based repayment plan, in the middle are set at 10% of this figure called discretionary income. And so 10% is the amount of the discretionary income that's required to be paid toward the student loans. And this will be updated each year as the income information is updated. But as you can see, parent borrowers, unfortunately, under the ICR plan, which is the only income-driven plan available to the parent borrowers, their percentage, rather than being 10%, is going to be 20%, which results in far higher payment amounts. So one of the prime points of advocacy that people like me who advocate on behalf of student loan borrowers are looking for is more relief for parent plus loans. So this is the kind of message that I send to my elected representatives, is that we think parents need more relief. We meaning me. I think parents need more relief. Okay, next slide, please. So the SAVE plan is going to give you the lowest payments and is going to give you other benefits as well. But I do want to show you this table of payments so that you can find yourself on this table and understand what your payments would be under the SAVE plan. So you just have to look along the left column for an AGI that's closest to yours, adjusted gross income, and then family size along the top. I've just included up to 4, but if you have more children or dependents, your payments would be lower than those listed. And as you can see, the borrower who earns $40,000, for example, at the top, is required to make a payment if they are single under the SAVE plan, but their payment is just under $60 per month. And if they have a family size that is larger, their payment amount would be set at 0. And I do want to say that if your payment is calculated as 0, then 0 is what you're required to pay, and that counts as a payment, and that counts towards forgiveness, even though you haven't actually transferred any money to your loan servicer. And the payments that you see on your screen here are calculated at 10% of discretionary income. And that's the way the SAVE plan should be currently working if you have applied for that plan and have been granted a payment under that plan. I would like to inform you, however, that a number of loan servicers have made errors in their calculations that have come to the attention of the Department of Education. And so there are adjustments occurring to payments, particularly with the servicer called Mohila. And we've seen a lot of sort of volatility in the payments. So if you are concerned that your payment is not accurately counted, if it's not sort of matching up with these numbers, then it may be that you should reach out to your servicer with those concerns in order to have them addressed. And so these are the payments under the SAVE plan through July 1st, 2024. There's part of the plan that is not yet fully implemented and that will start becoming available to us July 1st, 2024. And what that's going to do is reduce the percentage of discretionary income that we have to pay under the SAVE plan. And it could end up between 5 and 10%. So it's right now, everybody has to pay 10% of discretionary income under the SAVE plan. But after July 1st, if you have undergraduate borrowing, so if you got loans from undergraduate school, to the extent that you borrowed for undergrad, the payments will only be 5% of discretionary income. And to the extent you got loans for graduate or professional school, it will be 10%. So you'll see there'll be like a prorated percentage between the two, which you'll see then on this next slide, please. So under the SAVE plan, you'll be paying a prorated share after July 1st. So what they'll do is look and see how much you borrowed for undergrad and how much you borrowed overall, and then come up with a prorated share. So for example, in this example, the borrower had $30,000 in undergraduate borrowing, $100,000 overall, which means that 30% of their borrowing was for undergrad. And that ends up resulting in a percentage of 8.5% towards the SAVE plan. So that's going to provide additional relief for us and lower payments, especially for borrowers who have only or mostly undergraduate loans. And that's deliberate because those borrowers are the focus of the policy. Next slide, please. So the last thing I wanted to say about these income-driven plans is how they treat interest, because this is probably the most exciting thing about the SAVE plan, and many of us will be relieved to see how this operates. Under the SAVE plan, if the amount that you're calculated to pay is not enough to fully cover the interest that is accruing in that month, then you will not be charged all that interest. You will be charged only the interest that your calculated monthly payment covers. So, for example, if you recall a borrower who owes only $10,000 at 6% interest would have $50 of interest accruing per month. So if their calculated payment was zero because of their income, then the government would waive the $50 and the Department of Education will not attempt to collect. So that borrower will not see their balance balloon as we've seen in past years, which is very unnerving and expensive for borrowers. And if you consider the case of the borrower who earns 100,000 or doesn't earn, who owes 100,000 at 6% interest, that's $500 of interest accruing every single month. And so if their required payment was, say, $300, they would have a $200 interest benefit every single month. And so that is extremely good news. There's a much less generous minor interest subsidy for the income-based repayment plan. And then sadly for the parent borrowers, yet again, another way in which parent borrowers are not going to benefit to the same degree because the income contingent plan has no interest subsidy. And then I'll take, please, the last slide before we turn to our questions. I just wanted to sort of reiterate a couple of key points. It is definitely my belief that you should look quite closely at all of your student loan data. And I know that it is confusing and stressful, and I think it is very understandable and human to sort of not want to focus on it. So I have no judgment for people who have just kind of put it out of their minds or even avoided it. I also want to say, it really can't hurt you to look at it, and it will help you a lot to know what you've got. It doesn't mean you owe more just by knowing exactly how much you owe and at what interest rate. So please get a clear inventory of your loans. Understand whether you have all federal or private or a combination of both. Understand what interest rates you have, whether there's interest that has accrued on your loans that you have not yet paid. Figure out what plan you're in, repayment plan you're in, and choose the plan that's best for you. If you need more information, we are here for you. We have gathered resources for you, made them available to you, and there's every reason to address this so that you can set up your circumstances the best way possible for yourself and your family. And so if your loans are in a default status, you can see that at studentaid.gov. Please take advantage of the fresh start. There's never been a better opportunity for borrowers in default, and this is time limited, so do that now. And understand that the time is not on our side when it comes to student loans. Interest accrues over time. So be realistic about the cost of borrowing. And then finally, just please recognize that the income-driven repayment plans are extremely beneficial for student loan borrowers. They have many, many benefits, including affordable monthly payments, interest subsidies, sometimes very significant ones. And moreover, the income-driven repayment plans are the only path to public service loan forgiveness and a longer term forgiveness that is not tied to employment, but that's available for folks who make payments over time and still owe a balance after, in most cases, 20 or 25 years, less time for people with extremely low balances. So Matt, I know you're looking at the chat and have seen some of the questions, and I would love to address the ones that you see there.
Absolutely. How do you decide whether to pay off your full loan balance or go for forgiveness?
So, I think that the first couple things I would suggest is first make sure you have an emergency fund of savings in the bank. You don't want to pay off your loans with your last $5, right? So you want to have enough cash in the bank so that if your car breaks down or if you get a hole in the roof, you don't have to put it on a credit card that's going to be at a much higher interest rate. So don't spend so much money paying down your federal loans that you end up having to use your credit card for stuff. Don't pay your federal loans off if you owe an expensive balance on a credit card. Pay that more aggressively and first before you focus on the federal loans. But if you have savings and if you are contributing to your own retirement account already, and if you don't have credit card debt or other less flexible debt, like private student loans, then you should consider, as your question poses, whether to pay off your federal loans or to try to move towards forgiveness. And I think that really is a tough question. I mean, it really depends on what you think your likelihood is of achieving forgiveness. So project that over time. I can tell you the kind of simple rule of thumb is that the more money you owe on your federal loans as compared to how much you earn. So the larger the disconnect between your earning and your debt, the more potential value you have to forgiveness. Whereas if your indebtedness is relatively low as compared to your income, then forgiveness is sort of less valuable. The other thing to think about is, if you're in public service and you're working full time, public service loan forgiveness can be earned in as little as 120 months. And so you want to contemplate, how likely you are to remain in public service as a career. PSLF does not occur for just, sort of dabbling in public service. It's for those of us who end up there long term. So I hope that helps in your decision making.
Thanks, Heather. How do I find out what payment plan I'm already in?
You can see what payment plan you're already in either at studentaid.gov or at your loan servicer's site. You do have to drill down through a lot of levels. You want to look at loan details, and then as you see individual loans listed, you often need to click for further details on the individual loans, and you will eventually get to where you can see what repayment plan you are enrolled in. So it's going to be under loan details.
Now, if I'm in income-driven repayment plan, like the SAVE plan, does my payment change every year, every tax year, if my income changes?
That's correct, it does. So you may have already given permission to the Department of Education to access your tax records on an ongoing basis. That's quite a new option for the Department of Education. In the past, you may have been asked to update your income information annually. You may still be if you have not given that long-term lasting permission. But yes, annually you will either provide the information or it will be transferred based on your permission, and then your payment amount will be adjusted. And you can also see on your loan account something called your IDR anniversary date. And that's when they anticipate updating your income amount. So yes, it's annually that your payment amount will be adjusted.
If I'm in the SAVE plan, will my payments go down on July 1st, 2024?
So if you're in the SAVE plan, you're correct that the portion of the rule that has the potential to reduce your payments will take effect July 1st, 2024. You may not see, you will see no reduction in your payments if you did not borrow for undergraduate school. If you did, then you should be eligible for a reduction in your payment, yes. I do not know if it is going to actually occur on July 1st automatically. I tend to be somewhat skeptical of the ability of the system and the servicers to implement new rules in a smooth or flawless manner, or especially on time. So I certainly will not be holding my breath to see any kind of a magical switch right on that date. What I would recommend that you do as a student loan borrower, if you have undergraduate debt, if you don't, your payments aren't going to be reduced. If you do, put a tickler on your own calendar for like July, and that reminds you to like check your accounts and maybe send a note to your servicer, because I think we may need to advocate for that. And I think that's kind of like to be determined. But I will certainly, be notifying Matt and the Office of the Treasurer so that they can do things like let you know if there's additional information. There's no reason to think that you have to apply for that change. But I'm also not totally confident that it will be automatic.
You mentioned consolidating Parent Plus loans with one's own education loans, and how that might not be a good idea sometimes. My understanding is that there's an exception to that, which is if you have 10 years of qualifying payments for PSLF on one or both of those loans, or close to 10 years, and you consolidate by December 31st of this year, then you'll just get forgiveness right away or pretty soon. Can you confirm that? Is that true?
Thank you. Yes, that is the guidance that we've been given. You can read that on studentaid.gov as part of the IDR or income-driven repayment account adjustment. If you consolidate loans that have already have progress towards forgiveness, like PSLF. So you've been working in public service for whatever period of time. If the period of the loans overlaps, so if you had debt on two kinds of loans, parent loans and student loans, and you consolidate them before December 31st, then the consolidation loan will be granted the number of months towards forgiveness of the maximum number on any of the underlying loans. So just as Matt said, if one loan has 120 payments or 118 months towards PSLF, and another loan has 20 or 0, and you consolidate them together before December 31st, the consolidation loan in its entirety, the full balance, will have the maximum progress towards forgiveness. Do bear in mind, if, as in the example Matt gave, you are not already at 120 payments, you may have to make payments for some number of additional months before you earn forgiveness. And if that consolidation loan includes a plus loan, a parent plus loan, you'll have to make those payments through the IDR plan in order to progress the rest of the way to forgiveness. So you have to sort of figure that out. Like, it could well be worth it, but you might have high payments for a little while.
Thank you so much, Heather. It appears that, I apologize, but it appears that we are just about out of time. But before we wrap up, well, first of all, I want to say thank you, Heather, for this extremely helpful and informative presentation. I really hope it saves a lot of money for all of you and makes your lives easier. One other bit of information I want to provide: for certain types of state employees, there are programs that offer repayment assistance. That is, the state or federal government will help make some payments on your loans for you. And this applies to some attorneys, health professionals, teachers, and educators who work for the state of Delaware. So if you're in one of those categories, go to de.gov student loans, scroll all the way to the bottom, you'll find the information on those programs. Teachers and educators, especially because there's some programs for teachers and educators that are open for applications right now, and they close at the end of the month. So check those out. It's not for every teacher and educator, so find out whether you're eligible. On another note, as I mentioned, if you want to go back and watch this live stream again, you can do that by using this same link that you just used to join the live stream today. The link to the last live stream is in the video description below. I'm sorry if we didn't get a chance to answer your question today. If you still have questions, again, email me at studentloans@delaware.gov, or go and look at the links and resources at de.gov/studentloans. You can also reach out to the U.S. Department of Education, and the contact info for them is also in the video description below. Finally, I already said this last time, but I again want to thank everybody who was involved in these live streams. Thank you to Heather Jarvis, Treasurer Davis, DHR, Department of Human Resources, Secretary DeMattias, Ashley Block, Wade and Daniel from GIC, the Government Information Center, and Governor Carney, and everyone else who had any role whatsoever in helping us with these events. And thank you to all of you for joining us today and for everything that you do for the state of Delaware. I wish you all the best of luck at tackling your student loans and making a better financial future for yourself and your family. So take care and good luck.